Partnered by Times Influence.
Hello and welcome to another episode at the 4th edition of Birla Sun Life Mutual Fund presents Voyage Navigate 2017 powered by ET Now. Now last time we looked at equity investments, and this week we're putting the spotlight on fixed income investments and the outlook for that sector in the Indian economy. Let's take a look. Our next speaker has over 17 years of experience in this field. He spearheads fixed income investments at Birla Sun Life Asset Management Company and works closely with a team of 5 fund managers and 8 analysts managing nearly 1,50,000 crore rupees. Please welcome the Chief Investment Officer, Fixed Income Investments at Birla Sun Life AMC, Manish Dangi, who will be sharing his thoughts on fixed income market outlook and demystifying credit funds.
When you get to see a lot of crowd in airports, and there are large queues to buy Maruti cars, all this is reflecting of very, very strong urban consumption. So we are fairly certain that since last year in April when we met, urban consumption has picked up and has gained a lot of momentum. But what didn't change over last 1 year is something that we were circumspect of, and that is the investment. This is our medium-term risk, and unfortunately, India continues to struggle with the very, very lowish level of capex. I think it's mostly to do with of course, excess capacities, but also that we have this twin balance sheet problems in our country. The banking balance sheet continued to get strained because of NPAs, which originated maybe in 2007 and 2011, but our banking is actually sitting on large amount of gross NPAs. Also, our corporates are fairly levered. If you look around in Asia and even developed markets, very, very few corporates, very, very few countries rather have such high amount of indebtedness in the top corporate. So these are the two big reasons. The capex hasn't come about in India, and unfortunately for us to have any durable gain for our growth for medium term, capex has to turn around. Over last 1 year as well, our inflation numbers have come off. The core inflation, which is a true measure of the inherent demand-supply gap in a country, has also been coming off quite secularly. The good thing is that I continue to remain very, very confident that India's inflation would kind of move down over next 1.5 years as well. My big confidence does come from the fact that there are two big reasons which would still help India disinflate further. One is my long-held view that India's real estate or property market is in a bear market. The other thing, of course, is that many of us who are monetarists, who believe that inflation is always and always a monetary phenomenon, must look at the banking balance sheet. Many of us know that the banking credit has not been growing very rapidly. It's actually very, very tepid. FY17 credit growth was just about 5%, which is another reason why inflation wouldn't really come back, and most probably country would continue to see a lot of disinflation in times to come. At this point in time, it appears that the interest rates wouldn't be brought down over the next 3 to 6 months' time. But given the general consideration on growth and inflation, our core view remains that next year when we kind of meet again in Voyage 2018, we would see interest rates coming off further from where they are right now. In 2014-15, credit funds or the corporate bond funds were still very, very small part of our AUM and industry's AUM. But since then, this category has actually taken a big lift, and it's become a very, very big asset class as such. So maybe it's apt for me to kind of explain and demystify for our investors and intermediaries and everyone who is involved in the market as to what are these funds. Typically, these are invested in A to AAA in terms of rating, across spectrum. About 40% of this large credit pool is invested in AA rated papers and about 40% in A rated papers. These funds, are from a sectoral standpoint are predominantly invested in NBFCs to the extent of about 30-32%. NBFCs and financials all put together is about 30-32%. About 6-8% is invested in energy and metal. And then there is a huge tail of diversified set of companies that these funds tend to invest in. These funds typically have run about 2 years of duration. They've kind of oscillated a few months here and there in and around 2 years over the last couple of years. Over 5-6 years, on an average, it's been about 24-26 months of duration. So that essentially means that these funds don't necessarily run a substantial amount of duration risk. And therefore, even in times when interest rates back up substantially, these funds don't necessarily give negative surprises. As far as the yield of the funds are concerned, they run about 2% extra yield. This is on an average about for last 5 years where the fixed deposits have been. These funds tend to earn about 2% extra over fixed deposits in terms of current yield. This is not the return I'm talking of. These are the current yields or the carry of the portfolio as we know it. And also versus AAA centric funds or AAA bonds as such, these funds tend to have a carry of about 2%. So instead of simply relying on the opinions of rating agencies and outsiders, or the sell side, so to say, our focus has been to, over the last couple of years, and particularly over the last decade, is to build our own capability to understand the credit better so that the performance of our funds, especially credit funds, is actually far better and we don't make big mistakes. Our funds in the last five years have kind of delivered about a percentage more over and above where the industry on an average has delivered. And to that extent, one of the reasons why we've been able to deliver is not because, we underwrote at higher yield. It's just that, the drawdowns for us have been non-existent. So with that, thank you very much. Happy investing.
Next up, Santosh Dalvi, partner and head indirect tax Western India at KPMG, gave the audience his insights on GST with a talk on GST implications for Indian economy and industry.
The backbone of this GST implementation in India is the IT infrastructure. And we all should be proud to know that as Indians, this GST will be operated through a GST network, which is called as GSTN, whereby all the state governments would be connected by a common network, and all business transactions at individual transaction level would get uploaded on the GST network. And the volume of that is 3 billion transactions per month. And all the transactions, so vendor and the customer transaction would be matched on the GST network. Nobody in the world or the universe has even attempted to do this, and India would be the first country to do this. And entire world would be, they are literally looking forward this to happen. And they would adopt this, and this would be the biggest gift India can give it to world as far as tax policy is concerned. And government is really working hard, and Infosys is already, putting this infrastructure in place. Why we need this GST? I mean, it's but obvious. The current tax structure is fraught with lot of anomalies, multiple taxes, multiple rates, and it's clearly inefficient structure because of the state taxes and central taxes. Okay, so how many indirect taxes are today at present? There are 17 indirect taxes. For each type of transaction, there is separate tax. And all these taxes would get subsumed or merged into GST. And that's the beauty of GST. And that would make the most or very simple tax structure where goods and services would get taxed by a common, tax regime. And that would really remove all the, anomalies, inefficiencies as far as tax structure is concerned. So we will have dual GST because of the federal structure. For every transaction, whether you buy or sell the goods or services, there will be, GST, which 50% of that GST would go always to central government, and 50% of that GST would go to the state government. Today, what happens, as per the current tax structure, the state which manufacture goods retain the tax revenue. So it is called origin-based tax structure. But under GST, This tax will go to the state where the consumption happens. The ultimate tax cost will be borne by people like you and me when we buy goods and services. So whenever the transaction is from business to business, there should not be any tax cost, which is happening at present, and that is the biggest difference or advantage of GST. Today, tax plays major role, and that is what is going to be the biggest facilitator of business. So businesses can focus on how to improve their profitability, how they can have a better structure from commercial perspective rather than tax perspective. And that is the biggest advantage of GST. It's not a tax issue. It is going to lead to a complete business transformation as far as Indian businesses are concerned. There is not even a single aspect of business which will not be impacted by GST. Globally, it has been proved that wherever GST has been implemented, the prices, inflation has gone up, and the ruling government has lost the election also. So our government will not take any sort of chance in terms of leaving, any scope for inflation, etc. So they have brought the anti-profiteering measure. They want to ensure that wherever GST benefit is, achieved by the businesses is actually passed on to, end customers by way of reduction in consumer prices, etc. Then if you go to, impact of GST on economy, as I said, the overall cost of manufacture, because all these tax inefficiencies going away, would come down, and that would make our product the most competitive in the international market. So our exports should be, really benefited, and also it's going to be supporting our government's very important initiative of Make in India. India will literally become one country. All the state boundaries from the tax perspectives will go away. So India will literally become one united common market. The government is going to really benefit, whether it is state government or central government. It will lead to higher tax collection. Of course, as far as services is concerned, the tax rate currently is 15%. That would go up to, say, 18%. Plus, all the businesses would get covered under common tax law. So widening of tax base, that would lead to higher tax collections. It should have a positive impact on product prices because of the tax costs going down, tax inefficiencies going down. Now, there are many people operating in unorganized sector. They can't escape getting covered in the GST because of the fact that threshold limit and also all the transactions getting tracked on the GST network. State which gives better facilities, better employment opportunity, that would benefit, because the tax is on the consumption, not on production. That's about it from my side as far as GST is concerned. Thank you very much.
Moving on, it's now time to shift the focus to fixed income investments. Again, we have a list of eminent panelists who will share their views on the topic, credit selection, the art behind the science. To moderate the panel, I'd like to invite up on stage the editor for personal finance and real estate at ET Now and the editor of Mirror Now, Faye D'Souza.
Let's just help each other understand what these funds are and how they work. And I'll start with you because you did this so well when we were chatting earlier. So obviously, we're all used to the bond fund. We're all used to the short-term bond fund and the ultra, short-term bond fund, and everybody has sold that at some point or the other. Tell us how the credit funds are different.
So the credit funds, or rather the way we manage credit funds, is through active management. We actively manage the fund both on a credit perspective and also duration perspective. So while, medium-term plan or corporate bond fund may have primarily a credit mandate, the way we actually manage it is by active management both on the credit and duration side. Duration side, active management, most people generally understand, when dealing with fixed income funds, but what do we actually mean when we say active management on the credit side? I'll give you an example. In 2014, 2015, the macro credit environment was not conducive, according to us, to actually go out there and lend. We're not like a regular bank or an NBFC whose only mandate is to keep lending, lending, lending. We take a macro, our first initial thing is to take a macro call whether we should lend or not. And looking at the macro credit space, if we determine that the spreads are giving us a return commensurate to the risk we're taking, that's when we decide that, let's go ahead and invest over there.
So what you're saying basically is that you go out, you find a company that wants to borrow at the right rate, you structure a sort of a loan for that company, and you lend straight out of the fund.
Absolutely. But before that, the first thing is to lend or not to lend. Right. That's the first decision. So if we decide not to lend, we actually will not go out and find that company.
You will not go out
unless, we're able to do that bottoms-up analysis and find a company that is good enough, meets all the specifications.
Just to add on to what Sunaina is saying, what does the fund do? So in all investing, it entails taking on some risk. Whether it's an equity fund, it's a bond fund, it's a long-term bond fund, it's a credit fund. The kind of risk we're taking is the risk that a company will pay us back. It's a little bit of equity risk in there, in that, is it a good company, is it not a good company? But then how do you ensure in your instrument that you've structured to some extent, that whatever happens and whatever risks actually manifest themselves, your money will come back. So sometimes the lender itself, the borrower himself, herself, the entity is a very strong entity. In which case you may not need as much in the way of security. Sometimes the borrower is not as good an entity, and so this may be equivalent to what in the equity universe a mid-cap company is about. So here you would actually ensure, you would build a structure, you ensure you have collateral, you would ensure you've tied in a lot of things to ensure even when the risks do manifest themselves that you actually get paid out.
To add what Jasprit said, I think one of the critical things before we go ahead and do the final disbursement or pay-in is the credit underwriting piece. So internally, credit underwriting and monitoring are very integral components of the investment process. So in credit underwriting, our in-house strategy is always a bottom-up strategy. We just don't go and lend to anybody we like. So it's a bottom-up approach. We ensure that we have granularity of data from management. We ensure that we meet management at multiple levels so that we understand the entity's lending philosophy if it is a financial sector company. We understand what kind of intellectual capital or human capital they have. And having done all of these, we do a lot of field work. In addition to the desk work which we do a lot of field work on the ground with respect to these entities to understand before we lend. And at the end of it, once we have done all of these, we ensure that the covenants and the structures are properly interwoven to our monitoring and early warning mechanism, so that if credit health of the company deteriorates over a period of time, we have already inbuilt mechanism by which we can exit that entity at certain point in time.
Whenever we are doing any kind of underwriting, we put a lot of thrust on the cash flow of the underlying business. And we stress those cash flows to the extent that if 10%, 20% fall in, say, for example, cash flow, what will be the DSCR, what will be the asset coverage, and then accordingly we take the call. Over and above, we add the structure. So at the time of underwriting itself, we make a lot of provisions so that we have exits at various point of time.
Okay, I'm going to ask a very, very simple, very obvious question to any of you who want to answer this. Why is this type of fund better than a fixed deposit?
These kind of funds, when you look at the YTM of these funds benchmarked against, say, a one-year FD or a one-year AAA bond, they've actually, the YTM of these funds would actually be about 1.5 to 2% over and above, that one-year FD or one-year AAA bond. Post-expense, the returns on these funds have been closer to about 1.5%. So you're getting a fund that invests in a diversified basket of securities, not just concentrated in that one bank FD or that one corporate FD, At the same time, you're getting that additional nice thick return, which gives you a very good experience. So that's, basically the reason why you would come, into a fund like this, to earn that nice thick spread and that nice thick return.
Also, add on to that, so when you invest in an FD, where is your money going? It's actually going into the same things that we're talking about. It's going into an infrastructure project, going to real estate finance. To some extent, these funds are disintermediating.
But I don't need to know, because it comes back at the end when the FD matures, right?
If you look at the default rate or the downgrade risk, or default rate, to keep it simple, of the typical credit fund, there have been 3 defaults in 7 years. And today it's a 1 lakh crore industry. Banking system, we know what the default rate has been. But also, to some extent, a typical bank portfolio or a lending book is, I want to say the average rating is something like BBB. The average rating of the average credit fund will be AA minus.
I know you do a lot of infrastructure as well. If we look at what the banking sector is telling us, that there's no uptick, almost no uptick. There's almost sadness when it comes to infrastructure. Where are you seeing the opportunities there in infrastructure?
Basically, whenever banks are underwriting any kind of infrastructure projects, mostly they enter at the time of implementation phase. Whereas our differentiator is we enter once the project is already completed and the promoter is coming to the market for refinancing of that project. So that point of time, implementation risk is already behind. We are taking the market risk in terms of whether there will be a revenue, what will be the probability of that revenue.
So just to explain that, what you're saying is you don't finance the making of the road, but once the toll has begun, that's when you get it.
Yes.
Based on how much toll and how many cars are coming down that road.
So that is a part of our commercial analysis of any project. So entry point of any investment is that whether the project is commercially making sense. Apart from that, we have to also understand what concession agreement, what are the provisions in the concession agreement, which is basically signed between the promoter and the NHI, if it is a toll road project or even if it is an annuity project. So we have to marry these 2 things together with respect to commercial analysis of the project, as well as what are the risks which are there in the concession agreement. And after stressing the commercials, we have to understand that how much debt it can sustain. That we call it as a financial feasibility of the project. And then accordingly, we put the structures with respect to debt equity, debt to EBITDA, DSCR, asset coverage, etc.
To add what Sachin said, monitoring is a critical component of our investment process, as I said in the beginning. So to add to what he said in the structuring piece, in infrastructure, often we take sponsor support undertakings and things like that. So the sponsor is in addition to the cash flow analysis which we do. But when we talk of monitoring, our monitoring is a very premeditated approach. I mean, we start thinking of monitoring as to what we should monitor at what point in time, right at the credit underwriting stage. So that's the time when we try and understand what are the relatively weaker or negative areas of the company which we should look at on an ongoing basis even after disbursement. So we ensure and pre-agree with the company before disbursement as to what kind of granular data points we need in the form of information governance. And thereafter, what are the items to be monitored? They are very properly selected. So a lot of effort goes into what we should monitor and what we should not monitor. So as to ensure that the entire process of monitoring is effective, efficient, and at the same time simple. Because as you scale up your fund size, you have to monitor so many accounts which are, you can say, relatively in the credit space. Therefore, it is important that they are simple.
I'm going to wrap up this panel. It's been very educative. Thank you, all 4 of you, for taking time out. Thank you. You've been a good audience.
Equities, fixed income, Indian economy, global headwinds, industry stalwarts, and policymakers. All that and much more was a part of the 4th edition of Birla Sun Life Mutual Fund presents Voyage Navigate 2017, powered by ET Now. We hope we've been able to provide you with a comprehensive economic outlook for the year ahead. From the entire team, many thanks for watching.
Partnered by Times Influence.